as the constituents, between the banks as well as the constituents, to make sure that there is a mutual benefit to all parties involved. So without further ado, I will now pass the torch over to Pamela Washington, again, our case manager / resource specialist, and she will give a great introduction to our presenter today.
Yeah, thank you so much, Jasmine, for that introduction of our organization. Yes, and good afternoon, everyone. It is my pleasure to introduce Mr. Tommy Coleman. Mr. Coleman has earned his MBA in Business and Finance from Fairview AM University. He has spent 6 years in the military, where he received a commission as a field artillery officer. He has also worked as a telecommunication engineer with AT&T. Moving forward, he is currently a business owner for 25 years in the insurance industry. He is living his passion as an independent agent whose focus is on providing financial education and awareness to clients that leads to living a better financial solution for their lives. Mr. Coleman provides education primarily in the areas of retirement planning, life and health insurance, and annuities. He works with individuals, business owners, professional athletes, helping them save on taxes and creating income that outlives their lives. So let's welcome Mr. Tommy Coleman to the platform. So Tommy, take it away.
All right, thank you very much, Pam. I appreciate that. I'd like to say hello to everyone. And let me just kind of get all the technicalities out of the way here. So I need to go to share screen. Make sure we switch it over here.
Yes.
Ready? Sure. You see my.
Great. Awesome.
Right. So the advanced one, make sure that's working. Did that work? The
yes.
Okay, great. All right. I always want to make sure, I'm an old guy. I don't want to be stumbling and bumbling around. So, I thank God for Pam and Jasmine. They kind of help me stay straight because I don't want to get off track. But once again, my name is Tommy Coleman, and it's a pleasure for me to be able to speak to you all and address this internet banking concept. I'm sure it's a concept that many people have not heard of. And if you have heard of it, that's great. But it's been around for hundreds of years. It's nothing new, but it's new to a lot of us, meaning that, everyone has not been exposed. It's a very, very powerful concept. And as I go through the presentation, hopefully how powerful it is. Before we get started, I'd like to ask you if you have any questions as I go through it, just jot them down, because I want to make sure, and I will make sure that I need enough time at the end to address all of your questions or all your concerns, anything of that nature. I'm going to make this announcement twice. The first time is now for all of those who are on the call or on the Zoom. At the end, if you would want to get more information from me or set an appointment, you need to go through Ms. Pamela Washington, and you can reach her at her email, which is pamela.washington@ZWHJCOC.org, or you can give her a call at 817-873-1104. I know that might seem like it's kind of fast, but I'm going to announce it again at the end. So without any further delay, I'd like to move forward with the presentation. The infinite banking concept, as I said, a lot of people may not have heard of it, but that won't be the case after today. Our objective here is to financially educate, empower, and assist individuals, families, and businesses with the knowledge needed to create generational wealth using cash value life insurance. And what we'll talk about today, I'll do somewhat of an overview to just kind of shape or frame the concept. And I'll talk about the types of insurance. I'll talk about living benefits. the history of insurance in the low-income community. I'll speak about bank-owned life insurance, and then we'll get into the benefits of becoming your own bank. All right, now, let's talk about what is insurance. This is just a general definition because insurance has so many variations of insurance. But one thing holds true is that insurance is a means of protection from financial loss. It is a form of risk management primarily used to hedge against the risk of a contingent or uncertain loss. And that's be it something physical or life, property, that's what insurance is basically designed to do. All right, now let's go into some types of insurance. I'm sure most people have some idea about insurance, and we're strictly talking about life insurance. And there's we have some understandings that's not quite up to date, and I want to kind of bring you. Basically, there are two types of life insurance. It's either term or it's whole life. Anything else is a derivative of those two. Now, with term life, just as it states, it's for a certain term. It could be for 1 year, 5 years, 10, 20, up to 30, maybe even 40 years. But it runs out at that term. Now, it does not build up any cash value. It's strictly life insurance. And it'll just, upon someone's death, it will pay. Another form of term is what's called return of premium. Now, with return of premium, the only difference is that it still does not build up any cash value, but at the end of the term, that 5, 10, 15, or 20, up to 40-year term, if you're still alive, all the premium that you paid will be funded back to you. So that's a benefit of. Let's move. Like I said, if you have any questions on some of these things, just jot it down and we'll definitely address them. Make that clear. All right, let's go into the next term or type of insurance. We're talking about permanent life insurance, also known as whole life. Now, whole life is pretty much the basic life insurance, and every other product of a permanent nature derives from it. Now, with regular whole life, it's a permanent policy, meaning that it'll go to 121 years, okay? And with that, you're able to build up cash value, and with basic term, you can have a benefit, a guaranteed income of or interest of up to like 5%, and it actually does build good cash value, and you can also receive dividends. Now let's talk about some of the derivatives from whole life. Well, we have universal life. It has a return potential of anywhere from 1 to 2%. It's also a permanent policy, and it builds up anywhere from low to no cash value. Now, universal life, a lot of times it may be tied into the stock market, and it may reflect what's going on there. So, you have some opportunity for, it's not in the market, but it mirrors the market and its performance. The next level we're talking about is the variable universal life, another form of whole life insurance, but it's tied directly to stocks. So in other words, the money that you place in your policy, a portion of it is invested into the stock market. And before we continue, I want to just make sure that people understand that life insurance in general is not an investment vehicle. It's not. But there are some derivatives that do lend itself to mirroring what goes on in the stock market. You can have a return potential anywhere from 7 to 10%. It's also permanent, and that gives you potential for a very high cash value builder. And the next one is the equity index life policy. It's not tied to stocks, but it mirrors the stock. It's not in it, but it mirrors. So as the market goes up, your money goes up also, but as the market comes down, your money stays right where it is. It has a return potential of anywhere from 7 to 10%, and that gives you potential for pretty high cash value also. Let's move on. Let's just kind of give you a high level. Let's talk about living benefits. I don't know if any of you have heard of living benefits. But living benefits, let me take a step back. I know many of you have heard of death benefit. What the death benefit is, in your policy, if someone passed, then it pays the death benefit, whatever that value of the policy is, pay that out in the death benefit. Now, what the living benefit does, the living benefit, you're able to use it while you're still living. So let's dive into how that works. Well, with living benefits, there are two areas that you can currently use it in. If you're stricken with a terminal illness, that means if you've been given a declaration by the doctor that you got a year less to live, you fall in that category. Critical illness, that's an illness such as a heart attack, stroke, cancer, organ transplant, kidney failure, paralysis, and others. Then we have the area of chronic illness. These are conditions or diseases that affect the 6 activities of daily living. That being able to bathe yourself, dress yourself, feed yourself, transfer, tolerating, and continence. Now, the way that would work I'm gonna use a small example. Let's say if you have a policy, and this goes both for term and whole life, and you have a death benefit of $250,000. Okay. So you're stricken with one of these in one of these areas, and let's say that you need to have a chronic illness. It really doesn't matter, but let's say you need to use some of that money while you're still living. Let's say you need to you're not able to work, you're sick, but you need to have some funds to keep things going. Let's say out of $250,000, you want to access $100,000 of it. You could do that under the living benefit rider of the policy. And it varies from company to company as to how much you can get, but the fact is you can access these benefits while you're still living. And that's one of the big improvements in the life insurance industry. And I don't think a lot of people realize that, but it can very well come in to be very handy should you be stricken with any of these types of illnesses. All right, so now let's talk about some of the other uses of life insurance. Okay. This is one of my favorite areas about life insurance, and I hope that you all know about this. If not, it's my pleasure to educate you on it. One of the main uses that life insurance can be used to create tax-free income. As it's stated, income that you don't have to pay tax on. That's a biggie. If you can ever have anything that eliminates you from being able or having to pay tax on it, then you're really getting ahead. It can also be used to create income that you can't outlive. And that's probably one of the biggest things that we face as a nation that's aging. With improved healthcare, people are living a lot longer. But the key word is that you outlive the money that you have. When that happens, you're really in a tough situation. There's nothing wrong with living longer, but you don't want to get in a situation where you're pretty much destitute. So life insurance can help out in that. Let's talk about it provides protection from the government and creditors. What that means is that if you get in trouble, if you have bankruptcy, or if you get in some type of financial bind, they cannot touch your life insurance, cash value of life insurance, or any of that. And one of the key things that I love about it is that it can be used to create generational wealth. And generational wealth, that's one of the key components of our society. And if you can ever be in a position to create it, then that makes a great difference in whomever is affected. Right? Now we're going to get down to infinite banking concept. Like I stated earlier, this concept has been around for hundreds of years. Nothing new. The average person, I'll say, just haven't heard. Now let's talk about this infinite banking concept. It's known by many names. It's also known as your family bank. It's known as your bank. It's called your personal bank. But all of those fit. And there's a book that was written by Mr. R. Nelson Nash. It's called becoming your own bank. There's nothing new. It's been around a while, so let's dive a little bit deeper. Infinite banking concept. Now, this is the concept whereby cash value life insurance is used as a place to stockpile cash, create a financial buffer for tough times, and even create generational wealth. Now, who is it for? It's for the financially educated and the disciplined. Now, let me break that down. Being financially educated, that doesn't mean that you have to have an undergraduate degree, a master's, a PhD, none of that. What it means is that you have to have a solid understanding of finances and how to use those finances to improve your life, your family's life, to create generational wealth, all those things, and discipline. So all this goes together. So you can be self-educated. I just want to make it clear that there's no formal education involved in this. But you do have to have a knowledge of it and also exercise some discipline as you go forward in the program. So who does use the infinite banking concept? Well, it's used by wealthy individuals, used by banks, used by businesses and corporations. I put a star by the wealthy individuals because I want to get to a point where I show you where when this concept was first created, how it catered to just the wealth. Let's go into, many of you probably now thinking, well, why haven't I heard of it? If you hadn't heard of it, you wonder why you haven't heard of it. And I'm gonna show you exactly why you haven't. Before I dive into that, there was an article written in the Northwestern Journal of Law and Social Policy, and you can Google this. It's called Ending Jim Crow Life Insurance Rates. Ending Jim Crow Life Insurance Rates. And it was written by Mary L. Heen. That's spelled H-E-E-N. Mary L. Heen. Like I said, you can Google it if you want to read the whole report. But in essence, I'm going to highlight a key part of the paragraph. And this may help you to understand why you may not have heard of it. Following the Civil War, race-based practices first emerged in a specialized form of life insurance marketed to low-income working. Beginning in the 1870s, newly formed American life insurance companies, including Prudential, Metropolitan Life, and John Hancock, better known as the Big Three, they sold small individual policies to a growing market of low-income wage earners. Now, this type of life insurance was called industrial or burial insurance. It provided protection against the financial burden of a last illness and burial for the industrious classes. Now, although the rates and benefits varied by age, they did not vary, at least initially, by race of the insured, and were typically issued with fewer restrictions than other forms of life insurance. Policies covered poor workers and their families, including newly emancipated slaves, women, industrial workers, and their children. The industrial insurance agents typically sold policies door to door in an assigned geographical area or debit, and collected premiums of a few cents each week to cover each insured member of the household. Now, I know I'm an older person or older guy, but some of you may remember growing up that there were these guys that they came into the neighborhood, they went house to house, collecting, pennies or cents for policies. These was very low dollar policies. Most times the death benefit was no more than $2,000. But they end up paying on these policies for 10, 20, 30, 40 or more years, and they only had a face value of $2,000, $5,000 at the most. So with this shows you that there was a population of people who were targeted for these low dollar, low paying policies. And so with that being the case, they weren't exposed to the infinite banking concept. And you can see that it was by design. So this is why you probably haven't heard of it. And it's been around for hundreds of years because it was not designed for the general population. It was good targeted for those who had means or wealthy. I hope that kind of explains it. So let's go further to it. Now let's talk about bank-owned life insurance. I guess many of you didn't realize that banks own life insurance. You can Google this. You can go to the FDIC.gov and you'll be able to pull up banks and you can look at their assets owned. And I believe it's line 46. It shows how much life insurance they own. And you can look up any of them. They own life insurance in the billions of dollars in life insurance. Now, let's go a little deeper into this. Bank-owned life insurance is a form of life insurance purchased by banks. The bank is a beneficiary and also usually the owner of the policy. Now, such insurance is used as a tax shelter for financial institutions, which leverages tax-free savings provisions as funding mechanism for employee benefits. So let's delve into that a little bit deeper. So why would you think banks need to have life insurance? Well, a lot of the banks, they have life insurance on their employees. And as it stated, you know, they are the beneficiaries and are the owners of the policy. So you probably still ask and say, well, how is that a great benefit for the banks? Let's just let me give you an example. Let's say when banks go under, okay, you know, you may not hear about it. I mean, there was a point, you know, maybe 20, 30 years ago, because there was a lot of banks that were going under, they were in trouble. And so if you were like me, I said, wow, banks going under, man, it's gone. That's the end of it. Well, let me tell you, remember earlier when I spoke about the bank-owned life insurance that it can't be touched by creditors or the government. So when a bank goes under, they go under on what appears to be the surface that they're going under. But if they've got billions of dollars in life insurance, guess what? That's money they can access, start up another business, come back, you know, because that can't be touched. So that's why, you know, they safeguard themselves with that. So like I say, you know, you can Google FDIC.gov, you can look at all the banks, go into their category and see how much life insurance they have on their book. Another little good to know. Okay, now let's talk about the benefits of becoming your own bank. Some of the main benefits is that, as I stated earlier, you can access the living benefits of the policy. You can establish a policy and build up cash, build up large amounts of cash. You can get tax-free loans on it. You can also have multiple banks. You can have multiple banks if you can just kind of envision that. You will also earn guaranteed interest. You're going to have tax-free growth. You're going to have a tax-free death benefit. And you're also going to receive dividends. You get disbursements at death, you know, and it won't have to go through probate. It can pass directly to your beneficiary. And here again, it's also protected from creditors and the IRS. And it can provide you with easy access, no penalties, you know, for accessing the money you got there in the policy, no fees, no RMD. What RMD is a required minimum distribution. If you've ever had a 401k, it has, in regular IRAs, they have what's called an RMD feature on it, required minimum distribution. What that means is that you have access to it initially at 59.5. You know, you get the money out without any kind of penalties. But there's also another point where you're forced to take the money out, and it's at 70.5. But I think that's been moved 72 or 70, something like that. I'm not sure, but it has been moved. At that point, you are required to take a distribution, and that requirement is so that it can be taxed. Simple as that. So if you don't take it out, you're heavily penalized. So you know, it's as I call it, it's a rigged game. But anyway, let's just give you some insight on R&D. Okay. And this is just my statement from my exposure to life insurance. And I like to add this before I make the statement that, I've been in insurance, life insurance for the past 25 years. Even I had not heard of this concept until 5 years ago. I went to an insurance conference and we had a guest speaker who spoke about this concept. And I was really floored that this even existed. It was just unbelievable. But from that point on, I delved into it and saw that it's actually, a bona fide concept, and also that not any agent can do it. This is the type of policy where you have to know how to design it, put it together, and make sure that it does what the applicants want it to do. So, in my opinion, right now, life insurance is probably one of the safest places to store your cash in America today. And I base that on all the benefits I gave you leading up to. Now we're at the point of question. I told you I was going to leave enough time for you guys to ask questions. I hope you've jotted down, a lot of things that may have triggered in your mind, and just have at it. So since we're a small group, I think you can probably unmute yourselves and ask the questions. That way everybody can hear it. And I can address them that way because we've got time. So I want to make sure we have plenty of time for this. So anyone that has any questions, it's now open. There are no questions. I mean, so that means everybody.
I had a question. This is
okay.
Janetta. I missed your last statement about the required minimal distributions. And yeah, I know you're saying the life insurance policy, there's no required age.
Right.
But also when you do decide to take a distribution from it, you are being taxed, right? So you're saying it's a shelter if you don't take anything during your lifetime, but if you take something during your lifetime, it is taxed. Is that correct?
No, that's not correct. When I was speaking about being taxed, that was only referencing the 401ks and the IRAs, those types.
Right.
Life insurance, as I stated in the benefits, you can make withdrawals without any tax consequences.
Okay.
You can receive the benefits, they go directly to your beneficiary without any tax consequences.
Okay, thank you.
Good question, yes, ma'am. Next question. While y'all trying to get your questions together, if you want to delve more into this on your own to kind of self-educate, I've got a couple of books here. I don't know if you can see it, because sometimes when you hold it up, it shows backwards. But this book is called Becoming Your Own Banker, Unlock the Infinite Banking Concept. And it's by R. Nelson Nash. Mr. Nelson Nash, he's known as the guy who put all this concept together. And he's now deceased, but he has an institute, Infinite Banking Institute, that trains agents and helps people to really be able to put this into effect. So that's one book. Can everybody see that? Is it showing?
Yes, it's showing.
Okay.
It's showing very well.
Okay.
And we do have a hands up.
Okay, great.
Cassie. If you want to unmute yourself and ask your question.
While they're trying to unmute, and here's another book. Now this is a much smaller book that you can go through pretty quick. It's called Money, Wealth, Life Insurance. How the wealthy use life insurance as a tax-free personal bank to supercharge their savings. So that's book here, very small book, and it gives you a really good understanding of the concept.
So Tommy, Casey is asking if you can show slide 22 again.
You probably don't mean that one, does it? That's a statement of life insurance. That's the one?
Casey, you want to unmute yourself and ask your question?
Yes, ma'am, that's it. I needed to see slide 22 again. I want to make a copy of it, please. Thank you very much. Can you hear me?
You're welcome.
I can hear you.
Yes. Is that the slide you needed to see?
Yes, ma'am. Slide 22. Thank you.
You're welcome.
Hi, and Tommy, I know you were naming a couple of books. If you were holding them up, I was hoping to take a screenshot, but I wasn't seeing any pictures of the books, just seeing your slide that says questions.
Like I'm holding this one up. Can anyone see it?
Yeah, we see it. Terry, you
It
might
is
want to
now.
change your view. Change your view where you can, I guess it needs to be in.
Stop sharing your screen, Tommy, and then it'll go back to you on full screen.
Can it be seen now?
Yes, thank you.
You need me to hold the other one up also? Because you probably missed that.
I did. If you could hold the other one, that would be great.
Okay. And the other one is Becoming Your Own Banker. And Mr. R. Nelson Nats.
Thank you, Tommy.
Sure. I give you these books as a reference so that, you know, because sometimes I know things sound like they're too good to be true, and where they come from, that's something he's making up, you know, all those kind of things. So I always like to give a reference point so anyone can research and dive deeper into it. But as I stated, with this concept, in my opinion, strictly my opinion, is that, you know, right now, life insurance, that's probably one of the safest places to have your. Next question.
My question would be, so how do you go about starting a policy, or how do you refer to it? Or what are the requirements to get into it? And what's the cost?
Okay, now that'll have to all be addressed on an individual basis. And I don't know if you were on the, if you were on here when I mentioned that for any appointments or for any other avenues as far as information, that you have to go through Ms. Pamela Washington. And I'll answer some of your questions, but I wanted to kind of put this out for everybody, that if you want more information to be able to contact me, you need to go through Ms. Pamela Washington. Contact her through her email address, which is pamela.washington@Z as in zebra, W as in what, H as in Harry, J as in Jack, C as in Charlie, O as in Oscar, C as in Charlie.org. Or you can give her a call at 817-873-1104. But to answer, you know, some of your questions, so you know, it's all based on an individual basis. You know, this is no one size fit all, because if it's life insurance, you have to qualify for it. You know, it's based on age, the amount of insurance you're going to start with, health, all those things. But all that can be taken care of and provided for. So, and it has to be done by, like I said, not any agent can do it, because, you know, it has to be done through an agent who's been trained and how to design these types of policies. Because there's only about a handful of carriers that even address these. So I hope that kind of gives you some idea.
Yes, thank you.
Yeah, but like I said, you know, for more information and to be able to speak one-on-one to figure out how it would work for you and how it would apply to you, go through the Pamela at the Zans Homes.
And if I may, Tommy, integrating that, I really encourage those who's interested in learning more about the infinite banking and the cost of it to reach out to us so we can connect you with Tommy. As he said, it based on a lot of your age, and it based on I'm an infinite banker, So
Right.
I know when I started this, they always encourage you to start with what you can afford, but from there, you still the qualifications and they look at it. So to get that answer, he would have to get information from you, and you can look at where you would want to start with infinite banking, because it's reachable and it's attainable for anyone who's interested in becoming your own banker. So I encourage you to reach out so we can connect you to Tommy. So yeah, that's my input with that.
All right, thank you, Pam. And then next question. These are some good questions. I'm glad you guys are asking this. You know, it's good.
And Tommy, I do have my email address in the chat.
Okay.
For those who's interested in reaching out and getting more information and asking a meeting with you one-on-one to answer any if they have personal questions they might not can address here and want to talk to you personally, we can connect you that way. So my address, my email address is in the chat for you.
Okay, this is good. You know, let's have some more questions. I know some of you all out there, you know, if you, especially if you haven't heard of this concept, you've got to have some questions as far as, or maybe you're just that stunned by this. Which is it?
Hey, Tommy, this is Audrey.
Yeah, Audrey.
What's the earliest you suggest someone looking into starting infinite banking?
Very good question. Knowing what I know now, you know, I would encourage anyone to start as early as you can. And when I say that, let me break it down. Let's say for young people, if a young person can start something like this, let's say in their mid to late 20s, and if they are disciplined in doing everything they need to do, I dare to say, you know, as they get into their 40s, 50s, or whatever, they will be financially independent, because that's just how powerful it is. And just to give you another little concept, you know, of the banking concept, what it means is that you're using, when you start buying cars, buying furniture, you know, taking trips, anything that you would normally, you know, take a loan on to pay interest on, you're not financing it yourself. You're the bank. So you're accessing this, and guess what? When you get it, your money is still earning guaranteed interest for you. It's earning dividends. And as you pay the money back, because it's a loan, you're taking a loan just like you take one from anybody else, but you're paying yourself back with interest. So the interest goes back into your. So now anyone can start it, but the younger you start, you can see how the power of this kind of concept would just, you know, this is far better than any type of any other type of savings plan that's out there.
And it's only for individuals, or can it be for
It's
families?
for individuals, it's for businesses, it's for anyone, you know, that you qualify, you set it up. Anyone can access.
Thank you.
Right.
So Tommy, maybe I missed it. So if you're taking a loan out, you know, and I got the part that you could borrow basically your own money and pay yourself back, but you pay interest on it. What % interest are you paying back?
Typically, you know, the way it is now with the companies that I'm dealing with, typically the loan portion of it, you're getting a loan is somewhere between 3 to 5%. Okay. But to that point, let's say if you was even getting it at 10%, guess what?
You're paying
that back to yourself.
Yeah. Okay.
You know what I'm saying? So now that's more money going back into your pile. And one other feature is that, and I'm just going to use some numbers. Let's say that you got $10,000, you know, in cash value. And let's say you need to borrow $10,000 out. Okay, currently your $10,000 is going to be earning you interest, guaranteed interest, and dividends. So when you get the 10,000 out, that's not coming out of the money you got there. The company gives you that 10,000 from their general fund. So you get 10,000 from the company, the insurance company's general fund. So your 10,000 is still earning the guaranteed interest and dividends. So that never stops. So it continues to earn. So when you pay back, you know, then you're just satisfying, you know, the money that you got by the company. Does that make sense?
Yeah, it does. It's something
Okay.
that, you know, definitely wish I'd known about in my early 20s.
Oh yeah, me too.
But family members can definitely take advantage of something like
And
this.
that's my point, you know, and that's my point. The whole point is that, going back to what Audrey asked me, if we can get our young people, see, at some point we got to set up a stake. We got to put a stake in the ground and say, from this point forward, we're going to operate differently with our monies. We're going to build generational wealth, and we're going to keep it going forward. So now for people like myself, my age, okay, I can only get what little bit I can get because it's all based on longevity. But just think about your kids and grandkids, you know, that are young. If they embrace this concept, I'm telling you, their life will be totally different. We talk about the wealth gap, you will see that just shrink down. It will shrink down. But it's not that we don't have the money, we're putting the money in all the wrong places. That was a good question. There's some other questions.
Hi, this is Angela. I'm in the real estate field, and I was just trying to find out, because I know one of the ways of helping people build wealth is through real estate. But how would someone like me, a real estate agent, approach or bring up the subject of what we're talking about today for someone who may have had problems with trying to even get a mortgage? Would you say this would be an option for them to look into or consider?
Well, you said they're having problems getting a mortgage. I mean, it'll be based on what, credit, or just don't have the funds, or what?
So oftentimes, yes, it's a little bit of, it's high debt, and sometimes it's credit issues.
Right,
So,
well, see,
so yeah, and I've been trying to, just, I've been trying to, what's the word? Trying to kind of help those with both of those issues, consider, or look for different avenues of maybe getting,
right.
with getting help with trying to get access to financing. So I like the idea of what you're presenting today, where we would be like our own bankers in a sense, like you said. But does this work for someone who's, like I said, for someone who's trying to obtain home ownership?
It can, only if they're in a position, you know, to create a bank. And everything, that's why everything has to be done on an individual basis. Now, there'll be some people, you know, based on their current situations, that could not take advantage of this type of thing right now. But it don't mean that they can't. That means they may have to get the finances in order. Like I say, most times people have the money, but it's in all the wrong places. So if you've got monies that are spread all over the place, you got a bunch of credit cards, or you got a lot of debt here, all this stuff, then your money is, you know, all divided. So it'll be hard for you to create a bank because your money is all, you know, pulled away. And in my presentation, I said, you know, discipline. So the next step would be to help those individuals to get themselves in a position where they could do it. And all that depends on their age and, you know, their earning capacity. So there's a lot of things that come into play. And there may be some people who may never be able to use it because they may be too deep or too far off that they can't use it. That's why it works extremely well for young people who are in their prime earning years, and they start embracing this concept and taking it forward. So to answer your question, not that they couldn't, that had to be looked at on an individual type basis, you know, to see what their total makeup is. Because if they're in a situation where they've got some financial hardship, this can't really help them because they have to build a bank first. You know, the bank has to be built, then you access it. And that's what I help people with. You know, if some people are able to build a bank right away. Some have to kind of work toward it.
Okay, thank you.
Yes, ma'am. Those are some good questions, and it's like I say, I like hearing those, and I think it helps everyone. So if you got any questions you want to throw out, just throw them out, because no question is the type of question that shouldn't be asked.
Okay, so I have a quick question. So what I'm getting from what you're saying is your age determines a lot of the benefit that you can get. So for someone, let's say in their late 50s, is it even worthwhile for them to look into an insurance product, or is it more recommended for somebody that is younger?
No, well, definitely younger people, because they got
Yeah.
the time ahead. But anyone in 50s or 60s can still do it, depending on your individual situation and what you're able to do and what you plan on doing with it. And here's another thing you have to keep in mind too. When you start thinking about it from a generational standpoint, like I said, at some point we got to put a stake in the ground. Even if we don't get the full benefit from it, we position ourselves for that next generation to get it and keep moving it forward. Now let's use some examples. Let's say you got kids. Let's say someone is 50, let's say even 60 years old, and keep in mind that the infinite banking concept is still life insurance. So it has a death benefit. So let's say at whatever point you pass, your kids receive, or whomever, they receive hundreds of thousands of dollars. Okay, now, if they've got the mindset of they've been disciplined and taught that when this money come to you, instead of taking it, going out, partying, spending, buying cars and all stuff, create a bank. Now, if they get this kind of money, they can create a bank that'll be very powerful. And so then now, they created, so they lay it out so the next generation can benefit from it. Then the next generation can benefit from that. Do you see the concept?
Yes.
Okay, so yeah, anybody can use it. But it depends on, where you are in the situation. Let me give y'all an example of real world stuff. Everybody's heard of the Rockefellers, right? The Rockefeller family. Everybody's heard of the Vanderbilt family. These were, during that same time period, some of the wealthiest families in the country, if not the world. Here's a parallel. The Rockefellers, they had massive wealth. The Vanderbilts had massive wealth. The Vanderbilts, what they did was they started squandering their money. They lived high, they threw parties, they bought all kind of cars, they bought mansions, they just lived a high life. And as they did, the money, it dwindled down. It dwindled down to the point now where with the Vanderbilts, the last Vanderbilt that had any significant amount of money was Gloria Vanderbilt. And she just passed maybe 3 years ago. And she donated a lot of her money to charity. She's probably one of the last ones that have significant amount. And you probably know her son, Anderson Cooper. That's her son. So you say, well, how can she leave his money? Well, Anderson Cooper, he makes about $20 million a year on CNN. So, but my point is, their money, they mishandled it, dwindled down to they don't have the wealth they should have. Now, on the other side, the Rockefellers, what they did, they invested their money, they supported all the Rockefellers, anybody that needed to start a business or create enterprise, they supported them, and the money kept growing and rolling to even right now today, they've got as much, if not more, than they had when old man Rockefeller started all that wealth. So that's two parallels. And one of the things they did that I like, and there's a book called What Would the Rockefellers Do, if you want to follow up on that. Whenever a Rockefeller was born, into the family, they took out millions of dollars of insurance on it. And the trust or the foundations were the beneficiaries of it. So now, while these people were living, they had access to the money in the foundation to start businesses, make investments, do all that kind of stuff. But when they died, guess what? That money got replenished because the beneficiary was the foundation. So boom, millions of dollars went back into it. And so they've just flourished. So that's kind of a quick example of really how, like I say, you can have the money, but if you don't do the right thing with it, you won't have it long.
Yes, so, oh, sorry to interrupt you. No, the reason I ask is because I come from a family of immigrants, and they're very hardworking, and they have, life savings that are
Right.
just sitting in the bank. But,
Okay.
at the age of 50s, getting close to their 60s, and that's their retirement plan, just savings. And
Okay.
that's why I asked, because I know they've been curious about investing. And I'm wondering if maybe life insurance at this point in their lives would be a better option for them.
It would be safe, and you have to look at it on an individual basis, of course. But
Yes.
it'll be safe from a standpoint that, any money that you got in the bank right now, you don't know what the banks are paying. It's 0 point something. Okay. In the infinite banking system, you're getting guaranteed interest somewhere around, 4-5% guaranteed. And then the company pays you dividends. And the dividends can vary. Now, they don't guarantee the dividends because dividends have the opportunity to not be paid out. But the companies that are doing this have not missed the dividend payment in over 100+ years. So the point I'm trying to make is that you want to have your money where it can give you the biggest bang. So are you in a situation where you can earn anywhere from 8 to 10% or 0 point whatever and still have access to it? Because the money won't go away. You still have access to it.
Yes.
To answer
that
your
makes a lot
question,
of sense.
anybody can, based on a individual basis, anybody can look into it and see how it would benefit them, and they can determine if, yeah, this is I want to go this.
Thank you.
Right. And then also keep in mind the next generation. You got to keep in mind the next generation, because they're going to end up with that money in some form or another. But what are they going to do with it? That's the thing. So, I'm going to have to put together a presentation addressed to the younger groups who are going to be beneficiaries of a lot of this, so they'll know what to do. Because if they don't know what to do, we know what they're going to do. They're going to spend it. They're going to buy things. They'll do like the Vanderbilts did. They're just going to have a good time.
I have a quick question.
Yes.
So, and first, and also I had a comment, if you don't mind, with the lady that was asking about the real estate. One thing that someone had presented to me just as an optional alternative, it may not be an alternative to a mortgage, but they were like, this would have been a great solution for those people that need maybe down payment assistance or who need help with the down payment. So, because I know sometimes that could potentially disqualify some people if they don't have enough of that down payment saved up. So I just wanted to put that out there. But also, I guess my question would be, is there any way that someone, let's say that if I am creating my will and I'm looking for ways to leave my money, and I know lots of people traditionally may do a trust to someone, like I'll do a trust to you when you turn 18 or something like that. But again, that makes them accessible, or 21 because you think they're more responsible. But again, that makes them accessible to the money to do with it whatever they please. Is there any way where someone could set up in their final wishes where it's like, I want to set up something like this for my children or grandchildren or something like that, where it's like they have some sort of access to the money and they're able to borrow against the money, but they're not able to actually just squander it off and lose all of it?
Yeah, there's definitely a way to do it. And you mentioned it, from the standpoint of like a trust. The trust can be the beneficiary of the bank. And within the trust, you can determine at what point you want to have access. You may feel like a person may not be fully mature until they're 35. Or you may want to stagger and say, okay, at 21, you can get this percentage. At 30, you can get this, have access to this percentage. And you can just kind of control it from that standpoint based on who you're dealing with. And you can also designate, I'm always thinking about the next generation that, it can be used to start funding other banks going forward. Because all it's going to do is compound and get bigger and bigger and bigger. When you do that, now you operate like the Rockefellers. But yeah, you're right. That's a question. Okay, let's have some more. We going now. What do we got?
So Tommy, to get understanding what you just shared with Jasmine, so you can actually set up your infinite banking and put rules and policy in place on how you want it carried out, so it can go from generation to generation. Is that what you're saying?
No, not in infinite banking policy, but within a trust. Because the trust, and then the trust can be the beneficiary of the infinite banking policy. In other words, when you pass, it'll go into the trust, and within the trust, that's where you have instructions on how you want things to go.
Okay.
Yeah. Now, as far as life insurance, and in the life insurance, you can designate a beneficiary, and whoever that beneficiary is, once somebody dies, that's who you're gonna pay to. No matter what the age is. And I can tell you some horror stories on that, but people think a lot of times putting kids as a beneficiary, they mean well, but they don't realize that if you have a minor, the beneficiary of a policy, and let's say you pass prematurely, and let's say it's $100,000, it's going to go to that minor. But if they're minors, whoever their caretaker or whoever their guardian is, they're the ones who are going to have access to that money. And I can tell you some horror stories. When folks got of age, and a penny left. Let's give you the good and the bad. Good question, Pam. Let's review it.
Thank you.
Are there any other questions? I mean, it's you got time to address them. I really do enjoy addressing them.
I have a question. I've been learning about the possibility of our nation's economy and how the dollar is not really stable at this time. How would the economy affect your savings?
I just finished the document and about to mail it to you. About to mail it to you.
I'm sorry.
Email it.
Someone needs to mute herself, Ms. West. Go ahead. And
Ms. Blackburn, go ahead.
Well, I feel just place in, all you gotta do is sign it and get it notarized. Okay.
So I was wondering, how would, say if the dollar fails, what happens with the money that's in your insurance account? How is that safe from the dollar no longer having value?
Very good question. I'm glad you asked that. Now, to address that, you bring up 2 points. First of all, should that occur, should whatever financial situation that may occur, dollar dropping, all that kind of stuff. Here's the thing, with the life insurance industry, by federal law, they are required for every dollar you have on deposit to have $1 to cover that. So it's a dollar for dollar surety protection. Follow what I'm saying? Whereby with the banks, for every dollar you have on deposit, they only have to cover it with, I think like 25 cents. Something like that. So if you lose, if the bank go under, you're gonna take a hit. But with life insurance, it's a contract. And by federal law, they're required to cover it. They've got surety funds that cover any kind of losses. But history, life insurance made it through depression. Matter of fact, life insurance companies helped the United States to come out of the depression. they loan money to the government. That's just how even the smallest unknown life insurance company is worth billions of dollars. So I hope that kind of answers your question. So, you know, you are protected, your funds are protected. This is based on the contract.
Thank you.
So what you're saying is it's pretty much secure from any financial crisis, or?
I mean, I wouldn't go as far as say any, you know, because I mean, I don't know how, you know, it may come, but I know from a financial standpoint, what they're built up to do is to protect you from loss, because they have a surety fund that, you know, for every dollar that they have of yours, they've got $1 to cover. Unlike the FDIC. If we've been following our tribe studies and various things like that, we already know that should banks fail, we already know the FDIC does not have enough money to cover all the deposits. We already know that.
So what's the potential of an insurance company going under, and has that ever happened? Does it happen? And if so, then what happens to your particular policy?
As I stated, they have surety funds, guarantee funds. It works, okay, for you to better understand, it's kind of like the FDIC is supposed to work. If something go under, then they come in and cover the loss.
Okay.
So that's why I say with the guarantee, with the life insurance, they cover you dollar for dollar. With the FDIC, there's a bank that goes under, you're not getting dollar for dollar. You're gonna take a hit.
So even though it was with that particular insurance company, the coverage or the insured part of it is not through them, it's through the.
There's a separate
yes,
entity.
I got you.
Yeah.
Yeah.
There's a separate entity that guarantees, you know, should a life insurance or any other kind of insurance company go under, then you'll be made whole.
Thank you. I just wasn't grasping that initially.
No,
Thanks.
I'm glad you asked that, you know, because there may be other folks who it wasn't real clear, you know, because, you know, a lot of times people don't fully understand how, and a lot of this is regulated and mandated by the federal government. But, you know, they've allowed FDIC to be somewhat underfunded. And all of this is public knowledge. You know, if you dig deep enough, you'll see that, you know, there's trillions of dollars worth of deposit debt or deposits, but there's only like 500 million to cover it. Otherwise, I don't get paid.
So like for the banks, if you have over $100,000 in the bank and FDIC only covers up to 100,000, do you know how they allocate as far as each individual that have accounts that exceeds 100,000? Do they take care of the ones who have under 100,000 first? They do not lose any funds, or is there some type?
But see, that's a question that I can't answer, because, you know, in the event of something like that, they tend to change the rules. You know, whatever the rules are now, those may change.
Okay. And can I add to something, Tommy?
Yes.
As an investor that invests in, you know, believe in a diversified portfolio, the thing about having infinite banking, we're not connected to the stock market. So if the stock market go up and down and crash, whatever, your infinite banking, your policy is covered. So for me, it's like a hedge of protection against what I have invested in already. So if you want to look at it that way, for those who are investors who do have 401ks and other retirements that
mutual funds and all that stuff.
Yeah, having an infinite banking protects you from that stock market being connected to the stock market. So you will not be affected if the stock market crash. you will be protected if the stock market crash.
Right.
Yeah.
Very good, Pam. That's exactly right.
Yeah. So do we have any other questions? And what I would like to do is invite everyone to come back on the 24th, because I'm sure some other questions is going to surface throughout the week as you give this some thought. On the 24th, we'll be back here at 11, and we can go even take a deeper dive, and hopefully Tommy can even maybe do an illustration or something to show you how to work your infinite banking. And so with that, if there's any other questions, anyone want to ask before we close out?
And also, you know, on next week's Zoom, you know, you might want to invite some of your kids or, you know, folks who have a stake in something that you be doing so they can have an understanding.
Yes.
So that's the thing that hurts, is that a lot of folks who are going to be the beneficiary of things, they don't understand what they're receiving, and they don't know how to position themselves.
Absolutely. That's another good topic of discussion we can have on teaching our youth, our next generation, the skills of infinite banking, so we can each build our own empire. So if you're a guest and I don't have your email, because I see we have a lot of guests, and we have our Zen Wesley Home community here with members here with us on this call. But if you're a guest, share your email with me so I can send you a shout out and a warm welcome and a warm thank you for coming and visiting with us today.
Yeah, thank you very much. You know, I appreciate you all supporting this, and you know, this is something that I think is greatly needed within our community, because you know, it's not that we don't have the money, we just put it in all the wrong places.
Right. So thank you again. So we'll meet back here next week. Is there any other questions before we close? Okay.
All right, thank you very much.
Thank y'all. Y'all have a wonderful, blessed day today.
All right.
Mm, 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 mm.